Okay. Uh, yeah, today, May 24th, 2016, I'm going to be interviewing James Turk. He's the founder of Goldmoney, and he also worked as an international banker for 40 years at the Chase Manhattan Bank and the Abu Dhabi Investment Authority. James, would you like to say a bit more about your background?
Well, I've got about 45 years of experience in international banking and finance, but my specialty is really gold and investment strategy.
I see. And one question I would like to ask you that I think is quite important for the listeners of my channel is why is gold money? Like gold money, and explain to people, the history maybe of how it evolved as money.
Yeah, sure. Gold has been used as money for 5,000 years. It predates history, predates written history. And it was basically chosen by the market as the most liquid, uh, a liquid asset that would be available for use in exchange. Uh, it's different from everything else that we humans produce. Gold is accumulated; it's not consumed. It doesn't get destroyed. It doesn't disappear. All of the gold that's been mined throughout history is a cube that could slide under the arches of the Eiffel Tower. There's 17 times more steel produced every day than gold that's been mined throughout history, just to give you an indication of how rare gold is. But the interesting thing is that gold preserves purchasing power over long periods of time. An ounce of gold today buys the same amount of crude oil it did in 1950. An ounce of gold today buys a man's suit. An ounce of gold in Roman times would buy a Roman senator his toga. And the reason why gold does this is this above ground stock of gold, this cube that I was referring to, grows consistently year after year by about 1.75% per annum. And that's important because that's approximately equal to global population growth. So the supply and demand of gold is consistent over long periods of time, and therefore it maintains purchasing power. Now, the beauty of gold is that it's money that you own. It's a tangible asset. It doesn't have counterparty risk. It's not dependent on any bank or any central bank. And that, again, sets gold apart from other forms of things that we use as currency.
Yeah, well, that's great. Great explanation. And with that, I'd want to ask you also now about gold money and also the merger of gold money and BitGold, and how you're helping people save money or their wealth through gold, and also spend their gold. Can you?
Yeah,
Yeah.
exactly. I founded Gold Money back in 2001, and over the period of time, Gold Money has grown, and we're storing about $1.5 billion of customer assets, gold and silver, platinum, palladium, that we store for our customers in different vaults around the world. Last year, we did a transaction with BitGold, which was a new company that was created in Canada by two gentlemen called Roy Sabag and Josh Crum. And bringing the two companies together made a lot of sense. It was really, as I see it, a 1+1 = 3 situation. In other words, the two companies together were greater value than the two separately. And what we were able to do is to offer a lot of our customers, both BitGold customers and Gold Money customers, more services, more capability by bringing the two companies together. So after the transaction, BitGold changed its name to Gold Money. So Gold Money is now the parent company. It's listed on the Toronto Stock Exchange on the symbol XAU. And we have two operating divisions within it. We have goldmoney.com and we have bitgold.com. And they provide different services and different things. BitGold is a very inexpensive way to accumulate and save gold, as well as use it as a form of currency. And BitGold also has a debit card that you can load up and convert your gold into a spendable currency. The cards are in US dollars, British pounds, or euros. So it's a very inexpensive way to Actually, if you're traveling, for example, if you live in Great Britain and you want to travel to the States, you get a BitGold US dollar card. For 1%, you can convert your gold into US dollars, put it on your card, and then spend, which is much less expensive than trying to do foreign exchange through a banking system. But the advantages of BitGold and Gold Money is that you own physical metal. You know it's safe because of the chain of integrity and the governance procedures and policies that we follow. And that explains why both Goldmoney and BitGold have become so successful. BitGold is one of the fastest growing companies in fintech or financial technology. And even though it started just a year ago, it's got approximately 1 million users already.
That's very very good. And I also noticed that you can transfer Bitcoin into the BitGold account and turn that into gold, can't you?
Yes, that's correct. First of all, BitGold is nothing to do with Bitcoin. It's not a distributed ledger or any of the technology that Bitcoin uses. It's actually physical gold
Yeah,
that could be used as a form of currency. But if you own Bitcoin, you can convert your Bitcoin into gold and then hold it through BitGold. You can't take your BitGold and convert back to Bitcoin because of regulatory reasons, but you can come out of Bitcoin and go into gold through BitGold.
all right. The third question I have is a little more about the markets. There's many people, or analysts and commentators in the mainstream and also alternate media that see a financial meltdown as a necessary, something that could happen overnight, and that gold would benefit from that. So, are you in the same camp that we're gonna have like a financial collapse soon, and or are you more of a gradual? Do you think it's going to be more gradual?
Yeah, you cannot predict these things, but we know from experience that every several years we get a financial collapse. We had one in 2001. We had another one in 2008. 2008, 2009. So it's about 7 years again since we've had the last one. So I think we're due, if not this year, then probably next year for sure. Um, and my own view is it's going to be worse than 2008 for the simple reason that the problems are much more worse now than they were back in 2008. There's a lot more debt in the system. Banks are fragile. They're trying to paper together. Central banks are trying to paper together a system that's no longer sustainable. With this level of debt, you have to create wealth to service that debt. The economic activity is so poor that not enough wealth is being created to service the debt. Now, central banks have tried to counteract that by lowering interest rates to lessen the debt burden. But even with negative interest rates, the debt burden is still too high relative to economic activity. We've basically reached a stage where dependence on the state to do so many different things has reached its financial end, or will be soon reaching its financial end. And that highlights the importance of gold. It's been around for 5,000 years. It's been proven. It's money that you own. When you have physical gold, whether you have it in hand or you have it stored professionally for you, like we do in Gold Money and BitGold, you own that metal. You're not dependent on any bank or central bank if there were some kind of problems. Now, with bail-ins and in Europe and pretty much around the world, likely for the next financial collapse, you're going to see what happened in Cyprus and Greece, where depositor money is taken away. So my general view is that you have to have gold to protect yourself, to have money that's liquid without counterparty risk when that next financial crisis hits.
I see. Yeah, good advice in my opinion. And another question I want to ask you. I'm sure you heard of Professor Antal Fekete, and he's written about derivatives. I was reading an article he wrote about 10 years ago already, warning, how the system depends on derivatives, and how I think he says, the powers that be, they've encouraged, the investors and speculators to be long, the bond market and short the gold market. And so my question is, do you think a meltdown in financial derivatives is necessary to see, the next crisis, or is there something else that could trigger it?
It could trigger it, but there's so many different possibilities out there. The Italian banking system, for example, 19% of the loans that Italian banks have extended are non-performing. They're substandard for a number of different reasons. The aggregate amount of those 19% loans are greater than the equity within the Italian banking system. So the Italian banking system is basically insolvent.
Yeah.
It remains liquid because the ECB is providing them with liquidity, but they're basically insolvent. So, they could very well be the trigger. It could be a geopolitical event. Again, you just can't predict these things, but you have to basically be prepared come what may. And, derivatives are a real issue. But more generally, it raises a point, with this quadrillions of derivatives that banks have, banks around the world are carrying, and it literally is quadrillions of derivatives in terms of their obligations, that when all of this falls apart, it's going to be, sort of like us looking back today at the South Sea bubble or the tulip mania. 100 years from now, people are going to look back at this moment in time and say, how could they have been so crazy, to think that negative interest rates is going to solve their problem? Or how could they have been so crazy to put such a low value on gold relative to all of these paper promises that are out there? Or how could they have been so crazy to create all these derivatives or these levels of debt? We're in a bubble. And that's the theme of the latest book that I wrote, the money bubble. What to do before it pops, and we have to recognize from where we are within the long-term time frame, and what we're seeing today is basically a bubble in a number of different areas. But the most serious bubble is money. What people call today money is not money. It's just a money substitute circulating in place of money. Money is gold. Money is silver. It's not the paper stuff we carry in our pockets or have on deposit in the banks.
Yeah, I agree with that, and that's interesting that you've talked about these crises, and that in 100 years we're going to read. People are going to say, how could they do that? Because one question I had was about this book I've read many times, and you've done like a video, like a presentation with Max Kaiser called "Fiat Money, Inflation in France" by Andrew Dixon White, and so do you think, like, yeah, so I guess in 100 years we're gonna have someone written a book about fiat money inflation in the world?
Yeah, exactly right. And that's the issue that we as individuals have to face. The system is unsustainable. We have to prepare for it, and the best way to do that is to own things, tangible things, and avoid counterparty risk. Don't rely on promises of banks. Don't rely on promises of governments. Don't rely on promises of anybody. Own things, because after the collapse occurs, the farmland will still be there, the timberland will still be there, the houses will still be there. It's the financial assets, the promises that are going to disappear. It'll be a repeat of the 1930s in that regard.
And do you think it's going to take a very long time for things to, financial system and the way we live now to happen again? Is there going to be like a revulsion to debt, so to speak, in the next 15, 20 years after the next crisis?
Yeah, typically that's what happens. There's an American philosopher by the name of George Santayana who said that if you ignore history, you're doomed to relive it. And basically what he's saying is people learn from experience rather than reading in history. And that's unfortunate. But the net result is that, when you do have a collapse, people learn from their mistakes and then life goes on. And what we have to do is to, anticipate what the problems are going to be and be prepared for them so that come what may, ourselves and our families are protected. And again, the history has shown that with gold's 5,000-year track record, it's gone through wars, it's gone through Great Depressions, it's gone through recessions, but it still preserves purchasing power. So history has shown that when you're buying gold, you have history on your side.
Yeah, that's right. And that, okay, to wrap up our interview, the last question I have is about your technical view on the gold price at the moment. I read an article in King World News yesterday, and you were talking about the a rising correction in the bull market and how you think that's really positive for gold.
Yeah, exactly. You know, when you're looking at gold, you can't look at it really from day to day, week to week, year to year. You have to look at it from decade to decade. You know, gold has been rising since 1913, 1914. You know, the British pound had the same purchasing power in 1914 as it did in 1700 when Sir Isaac Newton created the classical gold standard. Since that time, and the creation of the Federal Reserve in the United States, the outbreak of World War I, national currencies have been separated from gold in a variety of different ways. They've been in the classical gold standard. They had a nominal tie to gold, but they continued to be debased. So, you know, back then, gold was $20.67 an ounce, and the pound price, I think, was something like $5 or slightly less, $4.75 £4 and 75 cents an ounce. You know, today we're 850 pounds an ounce, or $1,250 an ounce. Why is the gold price rising? It's rising because currencies are being debased. An ounce of gold, like I was saying before, preserves purchasing power over long periods of time. So to understand what's happening to currencies, you have to calculate the price of goods and services in weights of gold, which is the way it used to be under the classical gold
Yeah.
standard. To realize that currencies are being depreciated, that they're losing purchasing power. So when you're looking at gold, the way to approach it, in my view, is to accumulate it, view it as a form of savings. It's saving money for a rainy day, to purchase a consumer good, for your retirement, to preserve purchasing power. It doesn't make sense to save national currencies anymore because you don't get a fair rate of interest to offset the risks that you're taking by putting money in a bank. You're lucky, if you get 50 basis points, and inflation is higher than that. So you're losing money by holding national currencies. So view gold as a form of savings, and when you're saving, save it just like you would otherwise be saving a national currency. At the end of the month, um, based on what your family budget is, buy some physical gold, buy some physical silver, and just do that month after month after month, regardless what the price is. And over the long haul, you're going to be very happy that you've done that because gold preserves purchasing power over long periods of time, and it does so without any counterparty risk. You're not dependent on any bank or central bank when
Great.
you when you own physical
Yeah,
gold.
no, that's great, and like I guess people should worry less about all the daily, weekly, monthly price movements, and like you said, treat it as a saving instrument, and as if you're saving in your own national currency.
That's exactly right. The day to day, week to week stuff, just view it to be noise that can
Yeah,
be distracting from the big picture. You want to focus on the forest. You don't want to focus on an individual tree or trees. Take that step back and look at the big picture. And the big picture is currencies are losing purchasing power. Gold preserves purchasing power, and it does it without counterparty risk. That's what everybody needs to know.
oh, great, great, James. Thank you for your time, and yeah, have a good rest of the week, and I'll hope to talk to you again in the future.
Okay, great. Thanks, Mario.
You're welcome. Bye.
Bye bye.